Hi everybody, my name is Jeanine. I'm here with Dave Barnett from Attract Capital, and today we're going to talk about the art of the scale up. So Dave, can you please go into what the art of an acquisition, what it is, an acquisition
Absolutely.
scale up?
Thank you, Jeanine. It's great to be here today. An acquisition scale up is similar to another topic that we've talked about in the past, which is a roll up. And so today's title, The Art of the Acquisition Scale Up, a scale up is different from a roll up in that what you're trying to do is put two companies or more together, but you're trying to get more profit out of those companies by selling more product to the customers or getting some other synergy between the combination. So it's a way of a company acquiring another business to expand its products and to expand its customer base. And it's a particular type of deal that's really growing in popularity because it takes a while for companies to find new customers and to move into new regions and new markets. And when you can do a scale up where you buy another company and you can layer more products and you can sell more products to those customers, it's sort of killing two birds with one stone. So it's becoming increasingly popular, and it really catalyzes profit growth at the acquired business. With the goal being that 1 + 1 equals 3, right? And
Yes.
as we're going to talk about in a little bit, that doesn't always happen.
Okay, so that makes sense. So what kind of companies do you think are best to take in on this acquisition scale up?
So acquisition scale-ups are great for companies that are in fragmented industries where they're not overly local businesses, they're not overly mom and pop businesses. They tend to be recurring revenue, sticky customer relationships where there's contracts or where there's ongoing technology accounts. Often where it doesn't really matter where the back end or the operational work is being performed. It can be in one town, it can be another town, and where you can centralize a lot of that activity in one location. So, but if it's an overly local business or if it's an overly mom and pop business, those types of businesses are harder to scale because there's really just, when you look at it, there's less synergy. A lot of people think that you can put any types of businesses together, and the more the merrier, and the bigger the business, the more profit you're going to generate. But time and time again in the acquisition world, you find out that some businesses aren't meant to be acquired and consolidated, that the best form of the business is in a local kind of mom and pop ownership structure.
Okay, so is there a theory that comes behind these acquisition scale-ups, like something that makes sense for it to happen?
I think there is a theory, Jeanine. That's a great question. I would call it a theory. I think the theory is that you have to be able to see clearly, not in a overly far-reaching way, but in a very clear way, where you're going to get the economies of scale.
Okay.
So that if you put more activities together in one location, can you lower the costs of providing the service in the location? Or if you put a lot of revenue together, can you make the marketing and the sales approach for that customer service, can you make it more efficient? So the theory is that there's some part of the business model that by consolidating this, the revenue, you'll be able to enhance and make the business model more efficient. The other theory is that a lot of times smaller companies have underdeveloped customer bases and they have underdeveloped product lines.
Okay.
They might, in a given industry, there might be 100 different products, and a smaller company might have 5 or 10. There might be 100 different customers that you could have, and they might have like 10 or 15. So the theory is also by buying companies and putting them together, you get the benefits of the complementary fit. So if you have one company that has 10 products and another company that has another 10 products, suddenly you have a wider product line, and you can also have a wider customer base. So the key is centralization of services to make the company more efficient, economies of scale to make the company more efficient, and the complementary nature of the product and the customer fit.
Perfect. Sounds like some good stuff, and those are some major keys to success in having the acquisition.
It's easy to pontificate the theory, Jeanine, but a lot of times with an acquisition and scale up, you're buying a business and then you're transforming your existing business so you can sell more product to the wider customer base. A lot of times, when companies buy other companies, they don't have the inner structure, the strength within their business to absorb the company that they want to buy. When you're taking on more mass, you have to be strong to be able to absorb it, and you really need to have a lot of good management to be able to execute the combined company after you buy it so you can generate more profit. And a lot of times businesses, when you buy businesses that really can't be blended together, or if you buy a business and you don't have that inner structure strength, it just falls apart. And so you not only don't get synergy, you get negative synergy. So synergy is, 1 + 1 = 3. With negative synergy, 1 + 1 = 1, or 1 + 1 might even equals -1.
Yeah.
I've seen that happen. I've seen like two companies come together and they don't have
aligned.
They're not aligned, and it blows up, and the acquisition of the company actually, it's not a takeover, it's a take under of the company that's buying it.
Wow.
So weird things like that can happen, and you really want to avoid that, which is why it's important. The question you asked is a great one. What is the theory? Keep it simple. It's not too hard to think about, and just make sure that you're going to get some value out of consolidating this activity together.
And it also sounds like you need a lot of discipline within this process to make sure that the startup acquisition is going in the way that it should.
Absolutely. I think discipline is extremely important. You've got to have a team focused on the integration of the business that you're buying. You have to have a very strong roadmap, like a 100-day roadmap of what you're going to do with the business. And you have to have really strong operating metrics. So you're buying the business and you want this ratio, and you want your sales to be here, and you want your costs to be there. You have to be very data driven as you're going through it, because it's a very foggy type, almost a discombobulating experience when you're buying another business and you're trying to integrate it. So you really have to be organized, and you have to be very focused on those metrics.
I can imagine. And is it important to have someone behind you while you're doing this? How important is it to have the right kind of lender doing this process with you?
I think a lender is key to this. But just to go back to your point, like some of the other keys to success. I think you really mentioned, and it got me thinking, having the organization and the resources lined up so that you've got the inner structure strength. That's really key. But I also think it's also important to know exactly what you're looking for. Whether it's a product-driven scale-up or a customer-driven scale-up or a regional scale-up, you need to define your criteria and not grasp at straws, but have a really firm understanding of it and push it out there against all the possible companies that are available. And if you're disciplined and you're pushing it out there, then you're going to get a better acquisition pipeline. You're going to have more deals to be able to buy. And that's going to lead to having many targets, because when you're doing an acquisition scale up, the first deal in an acquisition scale up, and we were talking about this earlier, the keystone acquisition is vitally important. And when you have a larger pipeline, you're more likely to get this keystone acquisition. But having the right lender behind you is critical, because with the right lender, you can do so much more than not having the right lender. When you have a lender that will give you the money needed to buy the business for the acquisition scale up, but also, and just as important, having extra money to transform the two businesses together. If a lender's only going to give you the money to buy the business and you don't have any growth capital to transform the combined businesses, it's not as good, and you're likely not to have that scale up, increased profit effect.
That makes sense. So you need to be able to feel the vision along with also purchasing the business that you're going into. Absolutely
right. And it's kind of like, when you buy a business, it's an expensive proposition, but you want to be able to do things with the business to grow its value and to maneuver the business to unleash higher levels of profit. And it's a little bit, penny wise and pound foolish if you're not trying to raise additional growth capital financing from your lender. So it's kind of like, I think I heard somebody say, like, it's kind of like Well, I think you said it before. What was it?
I did. I said it'd be like purchasing a car and not having the money to put gas in it.
Exactly right. It's like you're over leveraged. You bought
Super excited and you can't go anywhere.
And that would be a great example of a failed scale-up acquisition.
We wouldn't get anywhere if we did that.
Exactly. So that's the same thing. It's like if you're going to buy something for $5 million, let's say you're going to do a $5 million acquisition. You need $5 million in cash. You need $1 million of extra capital to hire some more people, to invest in marketing, to bring in some new technology.
And you want things to grow, so.
Absolutely. You need to fertilize the soil of the acquisition so that you're going to have green shoots.
Yes.
Out of the combination. And that's what the scale up is all about, tilling the soil so that you're going to get that, shoot effect.
So in order to make sure that you're not just funding the business that you're buying, but also the vision and the growth, how easy is it to get financing for that?
Well, I think it's easy to get it if you know how to frame it.
Okay.
A lot of people one of the things about financial analysis is that people just look at spreadsheets and they assume that, well, the money to fund the transformation will come out of the profit once the two companies go together. But what you don't realize is that when you put the two companies together, people are going to leave and the bills might not get out on time and you might have some extra things that you have to pay. You're going to have vendors that need to get paid more currently. So there's lots of different reasons why your cash cycle might tighten up a little bit. So it's always risky if you're buying a company and you're expanding the size of your company. Let's say you have a $20 million company and you're buying a $10 million company. So now you've got $30 million in revenue. If you're counting on the profit from that combination to fund this transformation, that profit may not be there. You may not actually have that cash for like 9 or 12 months after the acquisition, if you're lucky.
Yeah.
If your cash flow cycle tightens. So what you really have to do is get that extra chunk of money up front, as you were saying, like money for gas so you can drive the car. Mm-hmm. Whatever it is you need to do, and we've done this with a number of our clients, we basically said, okay, you need $5 million to buy the company, but what do you need to do with the company? Well, it needs new technology. Okay, a couple $100,000 for new technology. What do you need? Do you want to expand with the company? We need more salespeople. Another $500,000 for salespeople. So we'll go down and we'll actually detail out all the different ways that they want to spend money. And it's kind of like a wish list.
Yeah.
So the 5 million becomes 6 million, becomes 7 million, becomes 8 million. And as long as you can present the deal to the lender and say, we need 8 million, that 8 million will get us this $5 million of it, this $5 million acquisition. Plus, we're going to invest this 3 to increase the margins, to increase the revenue, to increase the sales of the products, all these great things. Then the lenders get excited. So it is not easy to do, but if you have a holistic view of all the money that you need and the ways in which you're going to have the cash will be produced, the cash flow will be produced from investing that money, you can get a lender on board with it pretty easily.
That's great. So then if whoever's getting involved in acquisition scale-up, how would they know that they're paying the right price to get involved in something like this?
Excellent question, Jeanine. Price is everything. Price is the gift that keeps on giving. If you buy a company at a low price, you can make a lot of money. And a lot of people, unfortunately, just want to buy companies and they're not focused as much on the price. So you really need to know what the prices in your industry are, and you need to know what the price is for the different size companies. A company that does $2 million in revenue is going to be worth a lot less than a company that's $10 million in revenue, and the $10 million will be worth a lot less than a company that's $100 million in revenue. So you need to know where the breakpoints are, given the different sizes of the company, and you need to know what the industry multiples are. Right now, it's a really good time for people to be selling their company because we have bullishness in the economy. We have lenders that are relatively aggressive. So the purchase multiples for businesses have drifted upwards over the past 2 or 3 years. And for middle market businesses, they go anywhere from 5 times EBITDA to 9 or 10 times EBITDA. Yeah. So that means that if you pay 9 times, it's usually 9 years worth of profit that you're getting as a seller. So that's a lot of profit.
Yeah.
So it's important to, when you're doing a scale up, a lot of times you want to, the key thing is you want to make sure you're buying a good company that is a keystone acquisition. And keystone acquisition means, because when you're doing an acquisition scale up, you're going to do a series of acquisitions over maybe 5 acquisitions or 10 acquisitions over some time frame. The Keystone acquisition is the first one. That's the foundational acquisition. If that one doesn't integrate well with your company, if you don't set up the foundation, the platform right, then you're never going to get to the third and the fourth and the fifth deal. So sometimes, even though the price might be more expensive for the Keystone acquisition, it's worth it because you're going to get a better company that's going to have a better management team, it's going to have better systems, and it's going to have better customer relationships. And if it has all those things, chances are when you take it and you integrate it into your business will become stronger. So almost by buying a better company and paying a little bit more, you're going to become a stronger, more of a juggernaut when it comes to making the third and the fourth and the fifth acquisition down the road. You'll have more inner structure strength.
I was going to say that makes sense. You always want to invest in that proper foundation so that it becomes easier, I'm sure, as you begin to take on more of these companies to join in.
Absolutely, because it's all about the process that you have internally and can you really handle larger volumes of revenue that you're bringing in. I completely agree with that.
Great. So in order to wrap this all up, can you go into one more time some of the 4 keys to perfecting the acquisition scale-up?
Oh, we're out of time already, Jeanine? I'm so disappointed.
I don't want to leave everyone here on this beautiful afternoon.
I know, it is kind of getting late in the day. So the 4 keys to perfecting the art of acquisition scale-up. Key number 1. You want to get the right platform acquisition with good resources. As we were just saying, you don't want to buy a company that is a fixer-upper. You want to buy an established company that is a blue chip business that has really good people working at it. So you want to get a good platform company, and if you have to pay a little bit more, go ahead and do it. So number 1, get the right platform company. Number 2, make sure you have a strong deal pipeline, that you're priming the pump and that you have a lot of different companies that you can buy, because you always, you're going to look at it in some are going to be more expensive, some are going to be less expensive, and you want to have enough so that you can always buy a company, but you have to make sure that they're good companies. So a strong deal pipeline. Number 3, a willing lender that will provide the money you need for the deal and the cash and working capital to transform the business. Because it's not enough just to have money to buy the business, you want to have money to transform and to grow the business. And number 4, and this is the graveyard of this one is the graveyard of ambition for many a failed acquisition scale up. You need to have operational integration experts, people that know how to run the business, because it's not a financial thing. It's not like just raising money and buying a company. You actually need to have smart people that are experts at taking one business and stitching it together with the other business so that you indeed ensure that 1 + 1 equals
3.
There you go. So the platform, the deal pipeline, the willing lender, and operational integration excellence. And if you have all that, Jeanine, you're off to the races.
Well, that is great, Dave. Thank you so much. So there you have it. That is the art of the acquisition scale-up. So if you have any more questions or you want to inquire about this, please reach out to Dave or anyone from Attract Capital, and they'd be happy to help you with this. Thank you so much, everyone.
Take care. Bye-bye.